What we are seeing is the marginal and poorly run banks checking out in an adverse environment.
I think we're in the early stages, not the late stages of this banking situation.
When U.S. regional lenders Silicon Valley Bank and Signature Bank collapsed in March, there was hope they would be just one-offs. But the turmoil quickly spread to others.
First Republic, PacWest, Western Alliance, a number of these banks got into trouble, kind of for the same reasons.
Their stock sell-offs were symptoms of a bigger problem, an erosion of confidence driven by a liquidity squeeze brought on by the Federal Reserve's steep interest rate increases, plus poor risk management compounded by insufficient regulatory oversight. When confidence in banks fades, depositors pull out their money, leaving banks with less to lend out. The effect is worse for regional banks, which are dwarfed by the mega banks, because they focus on doing business in specific parts of the country, serving the industries, small businesses, and communities prominent there.
So what we're seeing when we see pressure on our regional banks, what we're seeing is pressure on a source of capital, funding, debt, that sort of thing for smaller companies that are looking to grow. And if your regional banks are in trouble, how are you supposed to grow the economy?
So to understand how we got here, we have to go back to the years of near zero interest rates. First, in the wake of the great financial crisis, and then more recently, at the start of the pandemic.
When there's zero interest rates, when money is cheap, basically, you end up with a lot of liquidity sloshing around the banking system. You see a lot of venture capitalists putting it into startups and other kind of options. And what that also means is you end up with a lot of uninsured deposits at banks.
Some of those deposits went into loans. Silvergate catered to the crypto crowd. Silicon Valley Bank targeted startups and founders. First Republic specialized in low-interest jumbo mortgages for wealthy people in coastal cities. But that still left a big chunk of cash sitting around on the banks' balance sheets. Their solution? Load up on safe, long-term investments.
We're talking government-backed securities, mortgage-backed securities, stuff that is considered basically risk-free. And that is a sharp contrast to 2008, the crisis back then, because banks took on a lot of risky assets.
This time around, banks were essentially making a bet that rates would not go higher. They were wrong. By April 2021, inflation was back in a big way. And the Fed was slow to respond. When it eventually began tightening policy, almost a year later, it had to hike rates aggressively. That combination of inflation and higher interest rates led people to draw down their bank accounts.
Instead of keeping it in a bank account that might be paying less in interest, they could put it in a money market fund. Then banks, realizing that there was competition for deposits, had to catch up by raising the rates they were paying at. When banks start to see deposit withdrawals, they can use the money they already have. Or if they see a really high rate of withdrawals, they can sell from their security portfolios, which for a long time have been a source of really ready liquidity for banks. But the problem was that due to interest rates being higher, the bonds that they had on their portfolios were basically worth less than what they had bought them for.
Now that banks were forced to sell their bonds, what was initially a paper loss crystallized into actual losses, which left them without enough of a capital base. SVB tried selling stock to raise money. First Republic got an emergency injection of cash from 11 other banks.
But that ended up really scaring investors and depositors who moved to pull out their cash.
And technology made it worse. Group chats, mobile banking, online trading created a vicious cycle of plunging stock prices, rumors, and digital bank runs.
Technology and communication tools are always part of banking crises. You know, the panic of 1857, it was the telegraphs.
As for regulation and government oversight, regional banks had successfully lobbied for less of it.
And their argument was that we're not as complicated as Bank of America, we're not as complicated as JP Morgan, why are we being regulated in the same way? That led to looser rules for those banks, and ultimately it's what the Fed blamed for the issue at SVB. Basically, they weren't looking as closely because they thought they didn't need to.
After the FDIC stepped in to seize the troubled banks and protect depositors' money, it sold off the assets to healthier banks. First Citizens bought the remains of SVB. JP Morgan Chase picked up First Republic.
This is getting near the end of it, and hopefully this helps stabilize everything.
As the last man standing among bank CEOs after the 2008 financial crisis, Jamie Dimon may have spoken too soon.
Even if we get past peak panic, this continues to be an issue, the fact that deposits have come down meaningfully over the past few months.
So what happens next? More regulation, for starters. The Fed has already outlined a list of potential changes which will increase costs for the banks. Maybe the cap on deposit insurance is raised above the current $250,000 per account.
We need to finish the bank crisis. So, whatever the FDIC, the OCC, the Federal Reserve, whatever they need to do to make it better, they should do.
The things that my sources are saying is that they expect consolidation, because this proves that the regional banks cannot compete. Even if they're in the same space, it's just not a level playing field, because too big to fail is still too big to fail.
For the regional banks that survive, they will tighten their lending standards and make fewer loans, slowing down the economy in the process.
If we're saying what could cause a recession, this is going to flow through. It's just a bad time to be small, whether you're a bank or a company in America right now.